What is good, YouTube? It's your boy Teflon Don, Only Traders, back with another video. Welcome. Let's get straight into it. And we're going to continue with the Candlestick Trading Bible. And today we're going to be looking at money management trading rules. So far, you have learned how to identify high probability setups in the market. This does not mean that all engulfing bar patterns are worth trading. Price action signals with low risk reward ratios should be ignored. So when they say price action signals with low risk, for me personally, 1-to-1 is good enough for me. I wouldn't go have a larger stop loss than the trade that I'm going to take, and I'm always going to make sure that my range is at least 15 to 20 pips, no less than that, so that I always have room to breathe when I take my trade and I want to hit my take profit. Once the criteria for a high probability setup are in place, there is no more analysis to be made. Just make sure your trade has potential of 2-to-1 risk to reward ratio. And as I told you, 1-to-1 is good as well. I mean that amount of money you win has to be twice the amount of money you risk or more. At the same time, 1-to-1 is just fine. 1-to-1 is it's good. It's good. 1-to-1 risk to reward ratio, you get your 10 pips, you're in and you're out, and you just have tight risk management. So see an example below. So as you can see on this example, this is his profit target, this will be his take profit, and this will be the stop loss. So you can see here that the ratio of the stop loss compared to the reward that he could potentially get is much higher, meaning that's a very good setup and a very profitable trade. But at the same time, 1-to-1 risk to reward is just fine as well, because you'll see that mostly with these 1-to-3, 1-to-4 risk to reward ratios, you're not going to win most of the times because your profit target is so high. As you can see, all the conditions were in place to take a buying order. The market was ranging, as we discussed before. Major demand and supply zones are the best price levels in sideways markets. The formation of an engulfing bar in the demand area is a good trading opportunity, but you have to look at the risk reward to make sure that the trade respects your money management rules. So you have to just make sure it respects your money management rules. This trade has 3-to-1 risk to reward, which means it increases your chances to be the winner in the long term, because if you risk $200 in this trade, you are likely to win $600. It is very important to calculate your risk to reward ratio before taking any single trade. Case study. Imagine you take 10 trades with 3-to-1 risk to reward on each single trade. I mean, when you win, you get $600, and when the market goes against you, you lose $200. Let's suppose you lost 7 trades and you won just 3 trades. Let's do the math to know if you are a winner or a loser. 7 losing trades will cost you $1,400, and 3 winning trades will make you $1,800. As you see, you lost 7 trades, but you're still making money. This is the magic of money management, and I totally agree with this. But at the same time, don't let it get into your head that I'm going to take 7 losses. Try to win every single trade, because we approach every single trade with a winning formula, and we do not just gamble. As the entry and exit strategy, don't try to be smarter than the rest of the traders. Keep it simple. You know what you're looking for when you identify an engulfing pattern, and you think all conditions are in place to execute your trade. Take an order immediately after the price action signal forms. Put your stop loss below the candlestick pattern and look at the simple chart to find the next support or resistance level. This is going to be your profit target. See the illustration below? So you just go to the illustration below, and as you can see, we've got our stop loss here. Here's our supply area, support level here, and it's a selling order. So as you can see here, you always want to have your stop loss above the structure when possible. Sometimes it's not going to happen, but when it's possible, this is a very good place to have your stop loss. On structures like these, where you have your stop loss just above the structure, very good place to have a stop loss, because most likely you're not going to get stopped out. And you can see the profit target here, right down to this support. So if you go back to my other videos, you'll see that this is kind of goes in conjunction with the concept of key levels. That price left this key level to come back down to this key level. It from this key level went up to this key level. So you can see that price is playing in between the key levels, and that's where we look to take our trades at the key levels. But that's for another video. When you set your protective stop and your target, don't ever look back. Let the market tell you if you're wrong or right. This will help you trade successfully out of your emotions. If the market goes against you, you'll not feel good. It's normal. Losing money can be emotionally painful. It is our human nature. Nobody wants to lose, especially when it's about money. In the trading environment, you have to think differently and accept the fact that losing is part of the game. It's just natural law, man. And when you even think about your life, man, just think about your life, bro. You've probably lost like 60 to 70% of the things that you've done or the things that you've attempted. But when you win that one time, that's it, bro. You just need to win once. It's just like the NBA, any sport, bro. They lose every season. Every season, everyone who doesn't come first is losing. But all you have to do is just to win once, and you're written in the history books and your life changes. Studies have shown that successful traders do not risk more than 2% of the equity on each single trade. If you're a beginner, don't risk more than 1%. Don't risk money you can't afford on a single trade, even if the engulfing bar pattern you identify indicates a high probability signal, because the markets are not guaranteed. You approach it with the winning formula, but at the same time, you know that even if you execute your winning formula to perfection, there's a possibility that you can still come out a loser, and that's okay. No matter how smart you are, you have to think always in terms of probabilities. Bear in mind that you can experience series of losing trades, and if you risk too much money, you will not survive longer. So basically that concept is, let's say you have $100 account. If you risk 1% on each trade, that means you have 99 trades to lose your money, apart from that first trade that you take. You have 99 more trades to lose your money. If you risk 10%, you have 10 trades to risk your money. If you risk 20%, you have 5 trades to lose your money. That's how it goes. So if you risk 1 to 2%, you're going to be able to execute more trades, and you're going to be able to last longer in the market. And as long as your account is still alive, you can always grow it back, even after a tough day or a tough week or a tough month, due to good risk management. It's just as important as taking the trade. The inside bar candlestick pattern. The inside bar candlestick pattern is one of the most powerful chart setups that professional traders look out. However, most traders fail to trade it successfully. Lack of skills and knowledge and poor education are the main reasons why most price action traders do not make money trading this Japanese candlestick. What is an inside bar candlestick pattern? An inside bar candlestick pattern is two candlesticks. The first one is called the mother candle. It's a big and large, and the second one is smaller, and it's located inside of the mother bar. Inside bar at the bottom. So let's look at this. This will be our inside bar candlestick. So this is the mother candle, and as you can see, price was in a downtrend. The inside bar candlestick pattern formed, and it began a reversal. So you can clearly see what it looks like. So inside bar at the top, the mother candle right here, inside candle. So this is a new pattern that we're going to be identifying, and you can incorporate it to your engulfing pattern as well. The illustration above shows inside bars at tops and at bottoms. As you can see, the second small bar is completely contained by the first one, which is the opposite of the engulfing bar pattern. The inside bar is seen as a reversal pattern because it indicates that the market trend is likely to change, especially when it's located at tops or bottoms. And just an extra thing that you can see from these moves is that you can see that market will be coming down and it's got large volume. Next thing, you start to see smaller candles because it's being exhausted. It's running out of momentum. It's running out of fuel. It's running out of juice. So the candles get smaller because the movers become exhausted. The inside bar is seen as a reversal pattern because it indicates that the market trend is likely to change, especially when it's located at tops or bottoms. It's also considered as a continuation signal in strong trending markets. According to Thomas Bolkowski, a successful investor and trader with over 30 years of market experience, a bearish inside bar pattern in a bull market can indicate a bearish reversal in about 65% of the time. And in a bull market, it represents a bullish continuation signal in about 52% of the time. And a bullish abandon baby, as he calls it, is considered a bullish reversal pattern 70% of the time in bull markets and 55% in bear markets. Bear that in mind. The psychology behind the pattern formation. The inside bar formation indicates a period of consolidation in case of a bullish trend. It reflects that the bulls are not buying any further on the second day. It is represented by small black candles on the second day after a strong uptrend. And in case of a bearish trend, it means that sellers are not in control of the market anymore. It is reflected by a small white candle after a strong downtrend. Your understanding of the psychology behind this pattern will help you identify major turning points in the market and time correctly your entry and your exit. How to trade the inside bar candlestick patterns? Well, let's find out. The inside bar can be traded successfully in trending markets, particularly if the market is moving strongly. Because the formation of this price pattern provides you with a great opportunity to join the big move. This strategy is very simple. You have to identify a strong trend and wait for the formation of an inside bar pattern in line with the direction of the market. The formation of this pattern indicates that the market pauses before making its next move. This will allow you to enter the market in the right time and make big profits. See the illustration below to learn more. So let's see that. Let's see what the illustration below is going to tell us. So as you can see, we have a lot. As you can see, we're currently in a downtrend. This is like just something you should just get used to, is trying to read what price is doing. Is it a downtrend? Is it an uptrend? Is it ranging? Straight off the bat. Before you look at anything else, try to see which direction it's going in. Entry after the breakout. So trading inside bars in trending markets, entry after the breakout. So you can see that this pattern forms, the inside bar forms, and that's when you take your entry. In the downtrend, forms again, take an entry. So let's read the illustration. As it is illustrated above, the market is trending down. The formation of the inside bar pattern gave us 3 opportunities to join the trend. So this is the case where it's being used as a continuation signal. If you're used to our trading approach, you only look for selling opportunities this way. You're not fighting big institutions and central banks. You're just trading in that direction that is favored by the market. So you're trading with them. You're not trading against them. Don't trade against them, man. With your small ass account, bro, you ain't gonna do shit. You can place a sell order after the breakout of the pattern, as it is mentioned in the chart above, and your stop loss order should be placed above the mother candle. Your profit target is the next support level. See another example below. So as you can see, this time we're in an uptrend and price is making higher highs and higher lows. A very strong uptrend with minimal downside. From the chart above, we can see how this price action setup works significantly as a continuation pattern. As you can see here, these will be our entries. As you can see, our entry point. It's a very simple pattern spot. You're not going to take all of these signals into consideration. You have to look for significant patterns that form in specific areas in the market, such as support and resistance, Fibonacci retracement levels, moving averages, or pivot points. Don't worry about that, because we will learn about the important trading tools that we'll need to use in combination with the inside bar setups to make the best trading decisions. How to trade the inside bar breakout with support and resistance. Technical analysis can be very complicated if you do not focus on the most important basics, such as support and resistance levels. So for me, my support and resistance levels are always my key levels. These areas represent a psychological level where the game is played between buyers and sellers. Let me give you an example. If sellers overcome buyers, they will push the price below the support level. Some buyers will feel afraid to lose money because they see that the support level is broken, so they'll get out and sell the market again to cover their loss. Other participants will notice that the sellers are in control of the market. They will decide to sell the market and help the bears push the price to go down. As a trader, if you have enough knowledge about support and resistance levels, when you open your chart, you'll notice that the support level is broken and the bears are in control of the market. This is a good selling opportunity, right? But the question is, what is the right time to enter the market? The inside bar pattern is one of the most reliable price action signals that will give you the right time to enter the market and make big profits. Once you understand how to use it in combination with these levels, you'll get clearly what the market is telling you and you'll make good trading decisions. See the chart below. So the illustration below shows how sellers broke the support level, right? Yeah, broke the support level. The formation of the inside bar after the breakout at this level signals indecision in the market. Right now, no one knows if the support level is really broken. If you sell at the market immediately after the breakout of this level, you are making an aggressive entry, which is a little tricky and dangerous because the breakout is not confirmed. So it might be a fake out. It might be so that's the danger of it, is that it could possibly be a fake out only for price to pull back into the range and return back above that support, and maybe you see it start to range before eventually actually breaking out. So that's what they're trying to illustrate. Right now, no one knows if the support level is really broken. If you sell at market immediately after the breakout of this level, that's an aggressive entry. But if you're used to trading with inside bars and you understand the psychology behind their formations, you will know that the safest entry should be after the breakout of this pattern. The breakout of this candlestick pattern is a clear confirmation that the market is still not in an indecision period and sellers are obviously in control of the market. So with that being said, the more time you spend on the charts, bro, the more you're gonna, understand how these things happen, and you're gonna be able to better anticipate it. Because when you're trading, you can always have your trading plan and your strategy, but things are going to happen in the market, and you have to be able to react on your toes unemotionally and make the best decisions for your account. So the more you trade, the more time you spend on the charts, the better you're going to be. Your eye is going to get better at spotting these things out. And I can personally speak from my own experience as a trader, is that the more time I've spent on the charts, the more I can anticipate moves and the more I can protect my account. So that's the key, man. Consistency. I wouldn't say hard work, but consistency, man. Just stay consistent on the charts. Whether, you're just chilling, you can be cooking, put your laptop there or your phone there, look at the charts and watch price move. Just try to see how price moves. That's all you need to do to brush up on your technical analysis, because that's just 20% of the game. So now we have an example here. So the chart above shows how the market participants interact with these levels and how the resistance level acts as a barrier. So you can see we've got this resistance level here, and we came to touch it once, twice, 3 times. So it's actually quite a strong resistance. And the thing with resistance is the more times we touch it, the weaker it gets. So eventually it's going to break out. And that's when the pattern formed right here. Stop loss below structure. This is a very good place to put your stop loss because it's right below structure, right above, right below the resistance that has now become support. And you know that most likely is safe and price is going to continue moving in your direction and you're not going to have any drawdown. The market has had difficulty rising above this horizontal level, prevents buyers tries from rising any further, but in the third attempt, buyers broke through the resistance level. What is interesting is what happened after the breakout. Look at the chart again. You'll notice that there's a clear inside bar formed over there. And as you can see from looking at this inside bar, you can clearly see that it closed bearish, but you can see that it made a long wick, meaning that price tried to go down, but it couldn't because there were a lot of buyers in the market. So basically, it's a confirmation that it's going to continue going up. So what will make the difference? The formation of this price action pattern indicates that the breakout is not yet confirmed. Remember, an inside bar formation means indecision and hesitation, so you have to be careful and bear in mind that a false breakout scenario is possible. What will make a big difference between you and other traders is your deep understanding of how this pattern works. In this chart above, you'll know what the best time to place a buy order should be after the breakout of the horizontal level. With that being said, that's going to come to the end of this video. And I just want to scratch up on something that they just said, just sorry. So yeah, you just have to be careful about the fake out, man, because you will get faked out more often than not, especially the more you look at lower time frames. So with that, that'll be the 5-minute, 15-minute time frame. So let's just say anything from 15-minute going back, there's a higher possibility for you being faked out by price, which is why you should always start securing your profits. So you should always have a level or a percentage where you know, once I've gotten 7 pips, I'm going to start securing profits. I've gotten to 8 pips, I'm going to start securing profits. Because maybe it's a fake out and price won't actually reach your target, and then it'll go back and now all of a sudden you're in a loss. And man, you just learn this shit from experience, man. That's how you learn it and you see it happen to you. And it makes you angry. But you know, when you get angry, you just want to improve and you want to get better and you want to get better. And that's how you do get better, man. You never actually notice the change up until later on. You start seeing, man, I've actually mastered this shit. So even if you feel like you're not going far in your trading, man, just keep doing it, because one day you're actually going to realize that I've actually done a lot and I am actually now good at what I didn't think I was good at before, and I can actually do it. I've mastered the strength for it. With that being said, man, all love out here. Like, comment, and subscribe to the channel. Content is going to get better. We're going to get better. And we're going to stay as a community for life.